And you ready, Chris? We're good to go? All right. All right. Welcome, welcome, welcome. It is Tuesday, March 11th. I'm here with my consumer buddies, Berna Barche and Jeff Mackey. We're going to start off by talking about a retailer from my home state of Wisconsin, Kohl's. Jeff woke me up with a message that says Wisconsin doesn't know how to retail. So tell me about that, Jeff.
Kohl's they continue to just dazzle with pure idiocy. Now, to refresh, in January of 2022, Kohl's was turning down three different offers. There are three different groups trying to give them over $60 a share, and they're haggling and they're just bitching and stuff. And I mean, like clockwork, that absolute top ticked every one of their fundamentals. Now, if you're on the board of directors, you have a lot of information, a lot of kind of insider stuff. That's part of being on the board, is they share the secrets and open the kimono. Since precisely that offer was made, the earnings are down 90 some percent, revenue is down about 25%, margins have gone straight to shit, and they might actually go cash flow negative. They actually might die. Like they need financing all of a sudden. There's a huge short base. No one expected anything from them, and yet they came out with a quarter that was just a train wreck. And so they're going to earn 60 cents versus $6 peak earnings in 2021, I think it was. So, and there's no real hope in sight. You kind of keep thinking that it's going to be a write-off year, but this is about the third or fourth year in a row that they're expecting a really strong second half to kind of buoy this weakness that they're seeing up front. Near as I can tell, they exist just to be the return center for Amazon, which is not in fact a growth business, because Amazon's getting better at just picking stuff up for you. So yeah, I'm sorry about that. You know, Menards is a good local retailer. Culver's, I hear good things about them. There's the toilet company. The Packers are a scheme. They're also a stock scam, but that's a whole different podcast.
It's just a stunning unwind.
Jeff is on fire. Yeah.
The unwind, to Berna's point, though, right? I mean, it's like, is Macy's or Kohl's the worst board on earth? Because at least Macy's neither one of them has a strategy. Both their strategies are like, we're going to close stores and that'll make us more profitable. And look,
like at least
we did a model without our bad stores, and we're so much better without our bad stores. Like, we'll be a really good company.
At least like Macy's has Blue Mercury, which is worth something, maybe.
Something, right?
And Bloomingdale's is still probably worth something, you know, like, and
Sephora is still kind of working for
square
Kohl's,
block
though.
at 34th Street is worth something, and they own some other real estate. Macy's is backed up by some good decisions between 20 and 100 years ago. So
Macy's chart looks terrible. That looks like it's ready to just take another keg dump down. Ugh.
I think the interesting thing, Jeff, and you know, I haven't thought about this enough, but like, I wonder where the Kohl, you know, is the Kohl's, you know, sort of decimation along with the Macy's decimation, like a lot of that sort of demographics and where young people go, you know, and sort of, you know, people, you know, their last great generation for Macy's was probably, you know, the boomers, right? And
right.
you know, even Gen X had moved into, you know, into mall and Amazon. So, but when you think about something like Kohl's, you know, is it Amazon's success with Amazon fashion? Is it Walmart getting its shit together on fashion? Is it Shein? And, you know, where is this customer? Because I was just reading that Forever 21, which is private, but, you know, a very large retailer, and one that was just nailing it, you know, 10 to 15 years ago, you know, everyone wanted to be them, is now closing almost all their stores. So like, where are people shopping for apparel that used to go to these places?
I'm just spitballing, but you know, there are so many places to buy shit now. And there's kind of just an endless growth in the number of places you can buy kind of the cheap crap that Macy sells, that Kohl sells. It's fine. No disrespect to like the Champion sweatpant crowd. We talked about them going into Target. You know, it's just the kind of product you can buy really literally anywhere. And I was thinking that when I was in Nordstrom in New York with my kid a couple of weeks ago, I'm thinking, you know, this is a fantastic shopping experience, this department store thing. But Nordstrom went upstream. And they're a great private company, but that because, you know, when things are down, the upstream's not so great. But when the Nordstrom's working, that's a differentiated shopping experience. It's a much better shopping experience than you're going to get someplace else. Macy's, Kohl's, they don't offer that at all. It's just that there's plenty of moldy stores I can go buy cheap merchandise in.
I must say that New York men's Nordstrom store, now also the main store, but the men's store is one of the most well executed retail concepts. Like people who want to go into retail should go visit that store. It's
Right. And Macy's is answering with like little cardboard signs that say 50% off as marked. It's the spread just has been nothing but growing, which is what happens to retailers when they stop investing in the stores. It's super expensive to run a good store because you got to do crap like, return. You have to invest in stuff like light fixtures, which Eddie Lampert was famous for dissing the ROI on light fixtures. And we saw where that ended. That's where it always ends. If your store looks like crap, no one wants to shop there because I can go to a flea market and get better deals.
And aren't these stocks like just this with this whole let's call it the plunge edition team of Trump and the what Berna called an unnecessary trade war? Aren't they just kind of screwed because you got the fixed cost base of employees and the rent, and then you got your costs getting now boosted up, and all I've heard from everyone is there's no ability to pass on prices. So isn't this just kind
Right.
of like this is just a bad situation for these kind of names, Macy's and Kohl's and these kind of dudes?
We were talking about it last night offline, and I was writing about it this morning. It's an unambiguous but very tangible headwind that's coming, and it's going to be expensive someplace. You're dicking around and things aren't going to become less expensive for the merchants, for the consumer, for anyone in the entire pipeline with a trade war, with a 25% tariff. Who knows how it plays out, but it's going to be bad. That's just super terrible. And if you're Kohl's and all of a sudden you're running at the bleeding edge of like, oh, you have liquidity problems, you were just going to be bought for $6 billion. You have liquidity. What the hell is that? But their margins are down to 1-2%, and they keep missing. So it's like, man, if that's what you're doing, well, they're kind of mentioning. I was listening to the call, so I was late because they have some financing issues, which they're going to take
Ugh,
care of this spring. Man, this is a bummer of a quarter to be going out to the banks and saying,
I need some money.
ignore that trend for the last. It's we're going to hockey stick this some bitch, and it's going to boy, these margins are going to improve a lot. I know we missed by 600 basis points last year, but that's why pencil savvy racers. I mean, I have no idea. They need to kind of existentially answer the question, why do we exist? And they don't even seem to realize that's a question.
Yeah, and
I'm furiously Googling who the private equity was behind Kohl's, and it was Acacia and Starboard, which are always sort of hunting around Macy's too. Also saw interest from private equity firm Sycamore, who's buying Walgreens. So something to keep
Yeah,
in mind.
and they kind of just said, "Oh, we don't think your financing is good," and it's like, well,
Those guys
years
were
later,
like
Kohl's is selling
fighting
for
to
pennies on the
buy this
dollar, and they're
company.
buying Walgreens.
It's at
Yeah,
6x the price now. So maybe
yeah.
something
I
to
mean,
keep
wouldn't
in
you
mind as we look at what other deals they go for.
wouldn't you just rather like if I'm gonna own a 1%, 2% margin retailer, don't you want to own Kroger? Like at least people need food. That demand is not in question, right? Like clothes and shoes and these discretionary items, and like you said, you can get it everywhere. So I don't know. Like if we're having grocery store margins, I want to go in the grocery store, I think.
Yeah,
uh,
I wouldn't want to
yeah.
own Kroger either though, because Walmart, Aldi, there's so many companies just that do it better for cheaper. And then you have the Whole Foods doing it better, if you want premium. I don't know. I hate living in the middle in the grocery store space too, as well. But
But it's a more
agree.
predictable grind. They very seldom have real pricing power they can pass through, but they're much more efficient at churning it out. What Kohl's is doing, there's so much variability in the way they execute. They don't seem to really have any idea. They're kind of blind driving with like only their fog lights on, so they can sort of see, and they're kind of aiming the car a little bit. No, we think discretionary is picking up. No, no, it's not. Holy shit, and we're in the ditch, and boy, we better get home goods up. And they have no idea. I mean, again, it's the board turning down an offer for 10x what it's going to be trading for by the end of today. They don't seem to be retail people, and if they are retail people, they should realize that they're kind of screwed. I mean, there's
Yeah.
not a playbook to get out of this. It's other stores have gone obsolete before them. That it happens. It's the circle of life.
You know what? Actually, there was a Wisconsin retailer that was very similar to them called Shopko. Do you remember Shopko at
Mhm.
all? Yeah.
Yeah.
So I
Yep.
think Kohl's always reminded me of Shopko. It
God,
was
does it
like
ever end with Wisconsin? I mean, this is just it's just
with the
bleak, man.
Packers,
It
with
it
the
should be
Packers, it does,
it should be an
buddy.
American experience. There should be someone strumming a guitar, a guy in black. I used to shop at the shop
Yeah.
go back when
Now that we're
they
Handing out
sold penny
cheese,
whistles.
handing out cheese. That's what they should do. They should get into cheese, like, hey, you come to Kohl's. Here's a nice piece of cheddar. You know what I mean? Like, you enjoy your shopping experience.
I feel like we're
You
aging
can enjoy
ourselves
that
and
while
we're
you
gonna
stand in line for like 3 hours while an 85-year-old woman goes through looking for her Kohl's bucks in the bottom of her purse, which is pretty much my experience every time I try to test shop the place.
So are these stocks just toast then? Like
terminal.
until we have like let's just look. We had a guy on our podcast last week who made this argument that rates are going to go back down to zero on the front end. They're going to get mortgage rates down. That's clearly what Trump and Basant's strategy is with all this madness of the tariffs and they don't want stocks up, so they want to get rates down. And he argued that housing related stocks are going to have a run. Now we got to get there first, right? Like right now, it feels like
I
we're
think it's a little
we're in the
early,
early
but
innings.
yes.
Yeah, we're in the early innings of this recession rollover. But there is going to be a point. But are these the kind of thing? Because these things had a nice run after COVID, right? When we had kind of the bazooka. If we have a housing bazooka, right, we get people refined, and are these things that can work, or is there? Let's go by Gary, who's having a rough run of it here. And by Gary, listeners, I mean Restoration Hardware. Berna and Jeff and I have a chat, and we just refer to it as old Gary, the CEO. But
A
like,
little bit of a fixation, actually, but yeah, fair
yeah.
enough.
He gives good conference call.
He
Hey,
does.
look,
He
he's
does.
done a great job, right? Like, like questionable what he's doing with this whole lifestyle,
You may sort of
restaurant.
jump the shark at this point. He's done an unbelievable job, but
Yeah, that's what I'm saying. Like, I'm no, like, it's just
yeah. But
look.
now,
Go ahead,
I
go
don't
ahead.
know.
He's
I
super
think
levered to all the same stuff. He's super levered to the high end person in about 5 different ways. And so he diversified the company by levering up more. He's got housing developments in Aspen, which holy shit sounds like a money bonfire. He's opening a store in Paris that's going to be 2 years late. That sounds like a Euro money bonfire. It's all these just ridiculously expensive things that he's pretty good at, but they're pretty far afield from selling furniture. He doesn't have a great track record. He's kind of top ticking with the prices. Ben, you were talking about that. I know he did it in England where, he said we're going to open this kind of estate in the middle of nowhere outside of London. And now they're missing in ways that are kind of hilarious. If this was like a business school case, he's saying things like, turns out there's not many furniture customers 50 miles outside of London and the bogs, wherever the hell the place is, and our furniture is kind of much too large for the houses here. It's just like, wow, it seems like stuff you should have thought about when you were spending 75 million building the place, but okay, whatever
Yeah.
works. I
I
mean,
would, yeah, I think it's way too early on the housing stuff, but when it's time, I would be more inclined to Williams Sonoma
But
has executed just phenomenally through this and is at a much more approachable price point, and with, different range. I think this sort of
and
boom,
can thrive in this
like the
market,
boom
can
of
actually do
the
things.
the boom of the high income is sort of a later cycle phenomenon, right? Like after the markets are up. Like if you're sort of doing first order, the people who are going to run and buy houses when rates are down are the people for whom affordability has been the issue, which is going to be more your entry level buyers or your sort of first trade up buyers. Whereas, Restoration Hardware is for McMansions, Williams Sonoma is for everybody.
yeah, so actually yesterday at one point building products were actually trading up yesterday. Stock, I don't know if you guys saw, but Rocket Mortgage bought Redfin yesterday. And I think that's going to be an interesting stock. It got dunked on yesterday for the deal, but Redfin was bought for 1.75 billion. In 21 that thing was $10 billion. So that could be an interesting stock to take a look at for this theme of lower rates and housing, and now they just added the Redfin to their network. Like, I think that's one that I'm going to do some work on and for the next cycle. But yeah, the stuff that's the most cyclical probably is the stuff you buy first, like the building. Because I remember in '08, some of that stuff bottomed well before the market. For example, like it was I mean, these things have been on their butt though, a lot of this stuff, right? Like,
Yeah.
Harley Davidson, we talked about it yesterday, was up 8%. I mean, who didn't know Harley Davidson's been just a disaster for a while, right? And they're doing the right things. When I looked at, because it's one of my buddies' like largest positions, well, they're buying back 15% of the stock. They still have good free cash flow. Some people like Harleys apparently. And so I just wonder if there's like stuff like that that's like this stuff to look at that's like absolutely hated. And Jeff and I were talking on the phone yesterday in like Gap last week, right? Gap didn't produce a good number, but it was up 15%. Her Harley Davidson's up 8 yesterday. Like maybe some of the stuff where there's not the exposure to the pods because everybody owned Costco and Walmart and the same stuff, and they weren't really short much. So it just kind of left, and it's not terminal like the stocks we started this conversation with, Macy's and Kohl. So they're like businesses that are just kind of forgotten or just unloved, or sentiment's low. I mean, maybe that's where we should be looking. What do you think about that?
I think the
Um,
risk is, I think you're right. I mean, I think the cash flow guys are the ones that are suddenly in play. That's why I like Gap. I'll buy the Gap dip. We talked about it on Friday. Celebrate it and said, of course you sell it. I mean, holy shit, do you sell it? Because it's going to, it needs a catalyst every single day. All the retail group is going to be powerless against just kind of random tariff announcements every 20 minutes or so. That's a really hard environment to buy consumer stocks. So, duck and cover, generally speaking, as this stuff plays out. But if you want to get brave, the difference between kind of a Kohl's and a Gap, it's is neither one is expected to do great things next year. Kohl's is actively getting worse and has a liquidity problem. Gap can survive just fine. Starbucks is in the same camp where they can muddle along. They don't really have any expectations. So if you think earnings are going to be trash for this quarter, probably the first half, maybe into the third quarter, and who knows what Christmas sales will be. But like we have a big negative thing happening that's creating obvious consumer problems, like right away, immediately. The consumer died in February. I don't think we need another retailer to tell us that before we believe them. Like I take their word for it. It slowed down a lot. So when does that speed up? I don't know. So I want to be long guys that can last in that kind of environment, particularly ones where expectations are sort of low. It buys them time, which they want anyway. Starbucks is going to need 4 quarters to start comping well and turning that thing around anyway. So who cares what they report next? They're not going to go bankrupt. They don't face Kohl's refinancing type risk. But the companies that are kind of marginal, they're a little sketchy, that are going to be recession problemed. That's what we've been trying to price in really fast, right? Because a recession wasn't something a lot of people were talking about 3-4 months ago. And now it's like just an assumed type of thing. How deep will the recession go? Which is the 50th time in the last 3 years we've had the conversation, but
Although,
it's a popular one.
although I would say it feels a lot more real now than it did in earlier. I think
Yep.
if the administration's policy is to try and get us into a recession, it's a little different um, situation. And
are you
looking,
sure that it's policy or it's not just accidental? Because I know that there's sort of this theory that
that's
they're
been my
trying.
thesis. That's been my thesis since last fall.
I know
That
that's
that
your thesis. Like, I mean, I guess it doesn't really matter whether it's accidental or intentional, but yeah.
Well, I think that what they want to do is they want to get food prices down. They want to beat inflation, and like they view getting the stock market down and the economy rolling over as the way to beat inflation. And I think to keep this to the consumer, as we're talking about, we've all talked about how the top 10% are doing 50% of the consumption, and so the only way to get that under control is the stock market. Like that's the only real, like we're so financialized, so people stock market, then they do the turtle arm move, they get a little nervous, people start spending, maybe they trade down to beer, Berna, and and from and whatever, like just people kind of like spend a little less, and then we get rates down, and then there's big savings. There's a lot of debt that has to get refied from COVID because the average debt life cycle is about 3.5, 4 years. So we're coming up on about that, all when all that deluge of debt was. And so, I think that's partially it. And I think they want to get the housing market working. Like the housing market is not really working.
Yeah, but
Uh,
here's the danger on and why I'm, sort of concerned and going through my whole portfolio in relation to preparing for a deeper, longer recession. It's like all great to do everything in service of getting rates down, but what is going to be the fallout on employment? And, because that is harder to turn around. You can sort of think about a lower rate environment and tariffs that somehow like pull investment into the US, and we, in this fantasy that we build factories again. But even if that happens, that's a those are 4 to 5 year time frames of new jobs versus people who lose their job tomorrow. And then spending doesn't go down 10%, it goes down 50% in those households. And you know, when the last time the market sold off, which was late 2022, like I was pretty fortunate in being clear-headed about buying those lows, and because I was comforted by the fact that I thought we had a good visibility on employment staying high. And as long as employment was high, people were going to spend money. But when people don't have jobs or are worried about not having jobs, that's when they don't spend. And, so to me, whether or not, they'll get rates down, but whether or not this is like a sort of short and painful correction where you have 1 year of lost earnings on these consumer companies versus something that's longer and more persistent that takes 2, 3 years to come back from is going to be related to employment. And that's where I have the concerns right now.
Right. And RH isn't going to survive 2 or 3 years of this. That thing spiked 50% on the idea of demand vectors going crazy and that leading to revenues. It's not at this point financially structured to hang out waiting for this interest rate housing miracle. That's a big problem for them. And that doesn't go away. What's a fair price for that? I don't know. We're getting at the point where it seems late to short and early to buy, just because you're
Yeah.
seeing things like RH going down 10% yesterday. Well, they didn't get 10% worse yesterday. It's just people noticed that and they started selling, come up with all kinds of reasons to
I
sell.
don't know. I think
Almost
we could
no
have
good reasons
another
to buy.
10%. I think we could have another 10% downside. I mean, I think every individual stock, I can't speak to,
Oh, we totally could, but it's I don't like that shot. Ben and I were talking about shorting Resto. We should have shorted the living crap out of it at
when we were
370. I
talking
threw a
about
little
it weeks
graphic. I mean,
ago.
it's yeah, but that went down 50% in freaking just in less than a month. It was February and it broke exactly the way it was supposed to. And man, that was just a yawning chasm. Anything that goes down that fast, that directly,
But the
it's
mental
pricing in a
exercise
lot of
I'm
what we're
going through
talking
right
about.
now is I have stocks that, were down, market's down 10%, they're down 10%. If they're worse positioned for a deep recession than the average stock, and they're down 10 in a 10 market, and, they're not at a single digit or near single digit P where there may be some kind of valuation support or some kind of projecting of the earnings coming down. To me, those are still candidates for a sale. And I'm, rifling through a few of those right now. And then there are other ones where, business is great and they're down 30% because a lot of pods happen to own them on the long side and they're de-risking. I kind of want to sell the stock that's down 10 in a 10 market when their earnings could be down more than 10 and they're exposed, so that I have the cash to put into that stock that may be down 30 or 50 but isn't dependent on restoration hardware. Like I was talking, maybe it was only like a week ago that I was talking about Flutter just knocking it out of the park, and it's probably gone from like 270 to 220 since I said that. Now, do I
Yeah.
think that they grow less? Like, do I think people make more $10 bets instead of $20 bets? For sure. But half their business is outside the US. So it's, so there's that. And then the half that's in the US was growing 35%, or if it slows to 20% and you are heading towards, a trough multiple, then, that is the kind, when you have sort of like a view on more states coming on, like more adoption, like it's a good long-term story that's probably only in the third or fourth inning. I want to have money to buy that. And, like one that I'm thinking of trimming, not the, I don't believe in it long-term, but like Disney, the parks are, sort of operating on all cylinders. That's not going to continue if we have a recession. So maybe I sell Disney to have a little flutter cash available. Those are the kinds of trade-offs that I'm thinking. I think there are two things that, I mean, in general, consumer is not the place to be right now. And I do about 50% of what I do is in consumer. The other 50% I need to spend more time thinking about right now because I don't think a lot is going to work in consumer. But the two things that can work are I think reasonably priced companies that are already washed out, like that have great cash flow and that aren't sitting in long books. So your Gap is a good example of that. My Crocs has already been beaten up as, single digit PE, trading with like zero value on Hey Dude, I think that that's not one that I'm probably going to trim at 100. And it's been kind of in a tight range, even in all this volatility, because it already got the shit kicked out of it in the second half of last year. So, something like that where expectations are low and valuation is low, or, there's always going to be some companies that that are going to kick the shit out of earnings and still beat because of market share gains and, the secular ones. But I think you just have to be careful on valuation. Like you need to be buying them at sort of GARPy levels and not at, we're going to the moon levels. Because we saw, that with Costco, with Deckers, like if the multiple's too high, no matter what you do, it's not going to be good enough. But if you're, more in that 20 PE and below level, and you have high visibility on beating earnings, those because of market share gains, those can work too.
And
Those
it
are the
depends on why you own the stock. I mean, looking at On as an example of something that I expected to take a beating, taking a beating, that's just fine. It's Deck has less runway than On to me, and I'm not owning On. On to me is a Lulu type of shot. If they can figure out apparel, that's going to be a multi-billion-dollar growth story from here. It's a little tiny baby in apparel, but they're taking, they had 77% growth in apparel last quarter. It was as good a quarter as they're possibly going to turn in this state. And the stock went right back up to kind of where the support would be, got a little spike, and then just got taken to the woodshed and hammered and beaten all the shit. If I didn't think that could grow into $110 type of position, but I didn't think it could have the potential to be sort of a Lulu multi-bagger where Lulu went through all kinds of cycles of misery. They're the pant recalls, the see-through stuff. I mean, it's things were not always a straight shot there, but you got paid off when they finally captured their share. And that's kind of the bet you're making with some of these shoe companies. I mean, I think we had such a great run with the everyone but Nike play that that just run out of a little traction. I mean, it's Nike's a little bit of a baby Starbucks. It would be $90 if they would have hired outside for a CEO. But another company that's just they're so huge, not a lot has to go right for them to be better.
You know who Nike's problems aren't helping? Kohl's. It was such a destination for Nike.
That's a good point. That's a good point. Jeff, let me ask you another question. I just saw that our colleague Robert Marson says he has a money death wish and he's buying more Abercrombie here. I'm looking at the weekly chart. It's looking like we might have to get the Jeff Mackey Christmas tree of death chart going for Abercrombie. We're almost there.
Raging Christmas tree of death. I mean, that is oh boy. Love Abercrombie too. That illustrates an idea on specialty. These are not stocks you marry. These are stocks you date for a while, and you have a nice long-term relationship with the Abercrombie's. If they're man, you don't fall in love with it because they get too hot and they're gonna just leave. Like there's no place for Abercrombie to go. They kind of won. That happened to Lulu a few years ago, and you got a little bit of a best case scenario where the stock went down like 30% and kind of just hanging out there because still being a really good company. That's your best case for Abercrombie right now is they're still going to be a really good company, but what's going to drive that higher? Gap and Abercrombie had kind of the same quarters, and Abercrombie is down 35%, and Gap is flat.
Oh, did we lose you?
Specialty retail. That's where love goes to die, man. Don't it's just let it die.
Those are by definition trade. I mean, other than maybe Costco, I mean, like once some retailers mature and isn't opening stores anymore, is there any retailer that has been a buy and hold forever? Other than maybe Costco,
and Walmart
with opening stores. I mean, Walmart went sideways for like a decade at one point.
Home Depot.
But that's so much harder. You're talking about kind of institutional and names that can come and go. In terms of just pure specialty, again, Gap is the GOAT of all time just for not dying, just for
Well,
kind of
yeah, but
still
it
being
also, I
relevant
mean,
this
you
long, but not a great investment since
it went
2000.
like
It's down 50%.
it went, yeah, I was gonna say like from the in the whole aughts, like there was like a decade where I looked and like in the decade it comped -7 out of 10
Yeah,
years.
but that's
You
that's
know
what
who they're doing
specialty
better
retail
than?
is.
Benetton. I mean,
What's
that's
that?
like most of them die. Most of them go away. Benetton is gone. Like
Or
Well, it's gone
Chico's.
in the
Lansing,
US.
don't
It
see
still
a ton of
Chico's.
exists,
them.
but just
20
not
years
here.
ago, Chico's was
Chico's,
the hottest
Tilly's. Yep.
stock. They did a Christmas tree.
Merry-go-round, Gazooks,
Hot Topic. Oh,
Red
geez,
Seal,
memories.
Charlotte Russe,
Exactly.
Limited.
These are rental stocks. These are trading stocks. This is why hedge funds have always loved trading these things. You trade the comps in the quarter, and do they get it hot? But like you said, there's not really been any. They've all had a lot of different nice times and runs. But I think Jeff's right. The Gap still being around is a testament to them. Like it is a not a business that like is meant for the longevity. It's more meant for speed, I think. And then then they run
Abercrombie's
out of
been
speed.
scorching hot twice. 10 years ago, 8 years ago, I was trading it with a friend of mine online. It was trading lockstep with American Eagle. They report this week American Eagle and Abercrombie took wildly divergent paths through COVID. And man, Abercrombie went up to 8, 9 fold, and American Eagle is right there in the low teens where Abercrombie left it in 2017. It's is that a good thing about American Eagle? I don't know. They're not an extraordinarily well-run company, but it just shows that like it's they all kind of return from whence they came. They're all part of the same mall, and sometimes they get hotter than others.
Yeah, I mean, and so I guess back to the point on this, where we started, which is that like these things have a way of going out of favor, and that's when you kind of want to buy them when they start to look like they're turning, you know what I mean? And so a lot of these
Yeah.
names that we're talking about, it doesn't feel like we've kind of flushed out yet. I mean, maybe Gary and some of the stuff. It's like when we think about what's viable, is you want it to be hated, flushed out, and then have some cash flow and things going for them where they can last.
And we're
And
past the hope point of the trade.
yeah,
They
yeah,
got to
yeah,
prove it.
yeah.
They got,
No hope.
Resto, the lesson of Resto and the reason to talk about other than our obsession is that people bought that thing up 50%, 80% based on demand vectors, based on an imaginary metric. Like it's that's how much folks want to buy these trades when they start to turn. But man, we're past the point that the oasis of a turn is going to be enough to drive the stocks. Like they rug pulled them pretty bad. They're going to need to prove it.
And I mean,
Yeah.
I think the thing to just remember, when you're looking at a turn, and I mean, we talked about this in the context of Dave and Buster's that's been on a, multi-year turnaround thing. Can you turn around a company when the macro is in your face and is a giant headwind? And, it's hard to think of companies that turned around in inhospitable consumer environments. Not impossible, but it just makes what is already a hard, I would say on retail turnarounds and restaurant turnarounds, probably if 1 in 4 works, that would be a generous sort of calculation. So you're already taking long odds on any kind of retail turnaround. And I love a retail turnaround because when they work, you get multi-baggers usually. So I will
And Q2 is going to set up
that.
to make amazing trades because the companies that show cash flow durability, the ones that actually don't get rocked by this, it's those are going to be companies you can buy. Those are going to be, I talk all the time about the companies that just didn't die. Stitch Fix reports this week. They're not going to say a damn thing that's going to reassure anyone about anything. Like that stock's just been murdered. It's high risk. It's high whatever. But if they've been moving towards kind of a cash flow positive situation, if they can get there despite the headwinds, then what's going to kill them? They spent 10 years waiting for that company to go bankrupt, and they're pretty close to turning the corner. Those companies, all those stories, Bernie, to your point, they're in play again. Like it's without a recession, there are a lot of survivors that don't necessarily survive something.
I'm
that
just
is a
not
deep
sure,
pullback.
that 1 in 4 rate probably drops to 1 in 10, when
Yeah.
it's a recession. So you have to be careful with turnarounds. I mean,
Yeah.
it was like, so somebody wrote me a message saying they're selling everything that's worked. They're selling everything that needs to turn around. They're selling everything that's on multiple. It's sort of like there's a long list of things that people think are not ownable in this environment.
But like let's talk about this in the context of Starbucks for a second, right? So I think Starbucks was not run particularly well recently, and they just were lazily taking a lot of price. And so is that turnaround, if we're let's say we're in a recession for the next year or so, okay, is that turnaround harder
I would
because of
not,
this?
I personally would not touch Starbucks because I think that Starbucks is, it never got past, it's always, for, yeah, the pricing, but also like the headwind of people not going to work is difficult for them. And so if we have a tick up in unemployment and white collar unemployment, it is going to hurt them. And, I think,
But they're sending a lot of people back to the office, though. I mean, like Jamie Dimon's come out. I mean, the government's
yeah,
come
I feel
out.
like that's already happened.
Sounds like it's like
I think
happening more.
where Bert and I disagree on Starbucks and why I own it is I think operationally in the way they ran their stores, just in terms of the way they related to their consumer, was ass backwards for about 5 years. I think you had Howard Schultz on the outside, like Obi-Wan Kenobi, just haunting every goddamn guy who tried to come in there and run the place. And then you had Kevin Johnson, and then the last guy who was in there, who were just kind of wonking it up. Starbucks makes a ton of money by having people deposit cash into that stupid ass app and go in and use that, which is that's fine as a KPI as long as you just hate the living shit out of your customers and you don't care how miserable they are. And you're just relying on their addiction to your product and caffeine in general to allow them to put up with this bullshit. And so they ignored metrics like 20% of the people ordering from the app never even pick up their order because it's like, this is chaos. I might as well just go to freaking the Greyhound station and get my coffee because it's the same basic crap. Starbucks can go miles with improving comp. So just treating customers better. You can already see it in the stores. And I think that if they were financially rocky, I wouldn't want to own them. Does it become an immediate story? No, but I like that about them because they're no longer arguing about things like whether or not the app is the way to measure success and whether we fight over our toilets and people can come in and hang out in our stores. Holy crap, just serve coffee.
But
Just shut the F up and serve
if they've
coffee.
taken pricing as far as they can take it, and they're not opening stores, and it's at a forward PE of 33, according to my Bloomberg, like what's the upside here? Is it going to be, it's not going to be price, it has to be transactions per store because it's not price and it's not stores. That's my problem with this. Like, I think they can do better and it's low hanging fruit, but I feel like it's priced in. I
It
don't
could be
see.
it could be
They,
margins. They could be margins, right? Like they're talking already about getting the menu narrowed down. They could be working capital more efficient. They could be more creative with the balance sheet and like some of that kind of stuff. So you might not need the top line in order for
But
it to be really good stock.
they've been redesigning
unless
the
they
back
take
end for 10
away,
years, billions of
unless
dollars, and they're still as slow as they've ever been.
if
So
they take
there's
away, they haven't taken away customizations, right? So they take away 8 drinks or whatever it was off the menu a couple weeks ago, and immediately online there's a million blogs and TikToks telling you how to recreate the drink that they took away by making customization. So I'm not, I understand what they're doing on the surface level to try to get throughput faster and, sort of man hours per drink down by simplifying things. But unless they take all those options off the app, I think people will still complicate their orders to a certain extent. And it's really dangerous to take away the customization options because people have had them for a really long time. And then you'll be really
we're a
mad.
bunch of caffeine junkies. You know what they've done? They introduced the metric 4 minutes, 4 minutes from the time you order until your coffee is in your hot little hand. Every customer can measure it. Every person that works at Starbucks understands that that's the metric. And that's something they can drive to. And they need to work it backwards from the customer experience. And customization comes down to, can we meet the 4 minutes? And I'm sorry, but your grenadine frappy extra squirt mocha latte cream filled thing, it takes 6 minutes to make. So we're not going to do that anymore. I think that Starbucks can afford to lose that customer because I think they'll make it up in people that again just want their caffeine fix, which I would argue is a not meaningless percentage. It's probably like 75% of their customers who are just like, listen, it's freaking daddy's nerves are knocking and I need some caffeine quick.
I mean, do you think they're under earning by, like a third? Because
A
I just
what?
look at that multiple and I'm like, a 30 PE on a company that's mature in terms of their store base, like,
I
the
think I'm not worried
earnings.
about their earnings this year. So I think their PE is probably understated on a forward 12-month basis. You buy them for the next 2 years. You buy them for, it comes down to whether or not the efficiencies that we're talking about in the stores, where that meets, whether that improves their margins, whether they can improve their throughput and still identify with that core customer. They need to stop trying to be Dutch bros. So decustomizing a little bit makes sense because Starbucks core customer is not 12, and it's nice to have your kid ride shotgun with you at Starbucks, but they don't need to sell soda and cream fills and stuff. Howard Schultz spent a quarter century going after food, could never figure it out. I'm not sure how much Starbucks is spending on endless food items, but it's not a diner, it's not a place to eat. Again, these are debates that it understates just how poorly Starbucks was run. When you come down to they're fighting over bathrooms, they're fighting over these huge menu selections, these really kind of obvious things that got ignored because they had 40,000 units and there's 5 of them on every street block in Manhattan. I mean, they're just the dominant player, and it's hard to see execution from there. But I think this is the best shot they have. If it's going to be a relevant company for the next 20 years, if it's going to be McDonald's rather than like Burger King, which kind of had its moment, this is when they're going to prove it.
Yeah. Well, it's going to be interesting, and I think you're right. Like, there's opportunity, and that guy Nichols is definitely a pretty good operator. He's proven himself at Taco Bell and obviously at Chipotle most recently that he knows what he's doing in that space. So it'll be interesting to watch. You guys got anything else? Otherwise, maybe we'll call it. It's getting, about time.
Yeah, it's about time. These are nice days to chat more. You're either trading the shit out of this market or you're just hiding under your desk and maybe playing some video games because you don't want to be halfway in this tape. I mean,
No, you can't be
things are
halfway.
a
You
little
can't.
ugly.
You
No,
can't. And I've
pick a
traded it.
strategy and stick with it.
I trade, so I'll just give you a little piece, like, because I've had this whole thing pretty nailed, and I've over traded a bit. So when you trade, like, you're like, oh, I'm trying to trade in and out, like you're like, hey, I shorted Tesla at 476, and by the way, Restoration Hardware at like 415, but I'm not, I didn't ride the shorts the whole way. I got about a quarter of Gary, and I got out of Tesla like 330 or something, and it hit 220. So it's hard to run this trade, and it's hard because you're getting the rallies you can back, and so you're either in, but if you're in, it's just as a human, you're emotionally like it's tough. Or you're kind of like what Berna's doing, like, I'm gonna go through my portfolio and see what I really want to own or what I might want to own, and then make a spreadsheet or maybe just a notebook and like write the levels where you're like, hey, I'd like to own this here, and create some alert system that's like, hey, now we're there. And I don't know if you do
Yeah,
that
I wrote a piece for
I
Stock
think
Market
I think
Media
you
today
trade too
talking about
much and
just
I
making a
trade too
list,
little is
just
my
making lists
takeaway.
of names that where you'd buy them.
Yeah.
Dick's reported today. I like Dick's at 160. Puns invited because frankly we could all use a laugh, but you know what, it's say what you will, that's a $200 stock. They reported great numbers. It's gonna go lower. It's gonna figure out a reason to go lower. It just is. People are just gonna bet against that. Now are Americans gonna give up sports? Well, things have to get pretty bad traditionally for us to like not buy our kid new shoes for whatever. Like, I get it. There's going to be a certain number of customers they lose, but Dick's is a really good company. It's a much better company than they were. It's put them in the line with Best Buy, but just companies that fundamentally changed and became much better operations during COVID as a result, really, particularly of COVID. Best Buy hasn't been recognized at all yet. Dick's is already wildly recognized, but so the stock's expensive. Let it come back in. They reported the quarter that I thought they'd report, and it's fighting to stay flat. That's the kind of tape we're in. So make lists and just figure out. I'd love to buy Uber in the 60s again. I'd love to buy Starbucks lower. And I'm willing to wait.
Yeah.
The challenge
Yeah.
is always like you can write it on the paper and then when the moment happens, like actually execute
You
it.
write it on the paper because, man, you sure as hell don't want to buy a
You
stock.
don't feel because when it gets there, you're not going to feel like buying it. And
No,
no.
because that's
But
20% lower for
It's
Dick's.
so it's
That's
so funny. I
right
always
on the paper.
I always think about the fact that I ignored like Airbnb. I wanted to buy under 110 and it got there twice and I didn't buy it. And it was, a huge mistake. It was one of the only times I just couldn't do, although it looks like I might get a third shot at it now.
But I think
Although
I think I think that if you can combine, hey, the technicals, like hey, the 300-day moving average or the 300 a week moving average, like some really long, like that plus you're like, I fundamentally know this business and I like it, and you can get those two, it allows you to say, I don't care what the market's doing, like I'm going to be involved here, and it gives you that conviction that even though it feels bad, but remember, it has to feel bad to get a deal. If it doesn't feel bad, you wouldn't be
Yeah,
getting a deal. You just got to remind yourself that this
correct.
is not like shopping at Kohl's where they just only give you deals, right? Like the also feels bad apparently, according to Jeff. And but 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 like when things are on sale, they're on sale for a reason.
right, that
And
makes sense.
yeah, so you just got to remember to tell yourself that like, hey, people don't like it. And there's a reason. So if you can get through it and you've done the work to
Well,
where
I
you're
think
comfortable.
I think the easiest ones to do though are going to be the ones with there are going to be companies with good fundamentals that can perform, on an absolute basis, maybe not a relative basis to the earnings estimates that are out there, but on a relative basis that can still grow their earnings. This is in consumer and outside of consumer in a recession, because of something secular happening. And those secular stories are the ones that the pods tend to be long. And when they all run for the exits and are de-risking, maybe some people will go out of business entirely. They will feel terrible to buy because they will feel like bottomless pits. Like when the consumer's crashing and like Gap or Restoration Hardware isn't doing well, you kind of know why people are selling. It's the ones that are really good stories, but then you're like, they just beat earnings, they're going to beat earnings again, everything's going great, but yet it's gone down 50%. What am I missing? Those are the ones that are almost the best opportunities and also the hardest to buy because it's so irrational. And so it's like something like, I hope it doesn't happen because Jeff owns it, but like something like On, running, which is a great story, but also, probably very overowned in pods. You could, it's like ones
Totally. And
like
could
that
easily be
make your
30.
shopping
Yep.
list and be brave because, like that's a company I've never owned because of the valuation, but he's right. There's a huge call option there on the clothing and they're doing good things. Like, I not for Jeff, but
And
for
you
me,
listen to
from
management,
Steve
you hear the
Super was
call, and they're just
dislocated.
crushing. They're doing great stuff. They're doing exactly what you'd want them to do. And eventually you got to figure, being smart at managing your company and executing it combined with, whatever ability we may or may not have to recognize a trend, like that has to work as an art,
Mhm.
as a way to invest in companies, or, we just should hand it over to the algos and stop talking or talk about more high
Yeah.
school hockey or something else.
I mean, I'm gonna sell a bunch
Uh,
of stocks. I just want to say one thing. I'm gonna sell a bunch of stocks today, probably, or the next few days, that to raise cash because I'm thinking back, like in case if the shit really hits the fan and we've got another 10 or 15% down, like I think about the moment and now I'm really dating myself, but in early 2003, I was able to do a really what I call like a really big portfolio upgrade where I went from like owning, you know kind of small cap, interesting stories, like to really great companies. Like there may be an opportunity here where we're going to be able to do like a quality upgrade on our portfolio.
so so I would tell you something. One thing that I've learned over the years, you want to buy the absolute dog shit when you're at the tradable bottom. The worst stuff is where you're going to get the biggest rip. Like everybody always wants to do the quality upgrade, and I get that, but the reality is the quality doesn't, like everybody's hiding in the quality in March of 2020. If you buy Dogecoin for zero point 0.1 cents, or you buy Kohl's or you buy Big Five sporting goods or those things, like if they can have life, it's like buying like a five delta option and they can totally rip.
Well, I
And
guess
so it's like
maybe
counterintuitive.
it's not just quality.
Gold is down
Because
21%,
I'm
by
not
the way. I
I'm
just
not
checked
talking
that today.
about buying Costco and Home Depot. I'm talking about buying On running, which has been too expensive for my blood all this
Yeah.
time. So maybe
No, no,
growth,
I
buying
get it.
growth.
I get it. I get it. And you want to feel good about the business. I understand what you're saying. Like, and so that, but that's the natural reaction, right? Like I remember everybody wanting to do that, and it is better, right? The best time that there I remember was in December of 18. Paul stole Christmas from us. Remember that when we were down 5% on
Oh
Christmas
God,
Eve?
yes. And we
That
actually
bastard.
bottomed over Christmas. There was a
It was
Yuletide
incredible.
miracle. Yeah.
Jesus Christ saved us. And so
Amen.
basically that was actually a time where I thought that was great. Microsoft and Apple. Apple was at like 11 times earnings there. Microsoft was at like 13 times earnings. Google, like that was really a time where buying those stocks was really cheap in that Q4 of 18. And so sometimes, but like opposite of that, March 2000 or 2020, they didn't get very cheap. Everyone was hiding in them, and like, look, they did great and that's why they're in trouble now because it just had such an insane run. You're now on like a whatever 7-year run. It was just so overowned, but like, but they didn't get, Apple never really got like that cheap in that
Yeah.
March COVID. So it just depends on what it is. But I mean, I also one last thing I'd say is the dirt stuff. Like, do you guys remember when Ackman bought the General Growth in 2009 and like
Yes,
probably his greatest trade of his career, right? Like
I
that.
I agree that it was the
Mm.
greatest grade of his career.
Yeah, and so like there is something to that extent too. That's like, hey, looking at stuff that's beat up and actually reading through the filings and
Mhm.
seeing what's going on is a way to get an edge as well. Because the
Yeah, I
macro is
remember there was a guy in 2002 from my business school class who was telling me he was buying AMT, American Tower, at
Mhm.
this was in 2002. We were having,
Oof,
and it look,
oof,
I mean, it was literally a dollar. I had been shorted probably from
oof.
15 to 1 and it just covered it. And he's like, I'm long now. And
That
that
was a
guy's got a
monster.
multi-billion dollar fund because that stock's $210. I mean, it's been 20 years. I don't
Yeah.
know if he 23 years. I don't know if he's owned it all the way through, but there was plenty of room for, became a 30 bagger in a couple of years, and it's been a 200 bagger over 20.
And that's, I guess, what I'm trying to say is that like thinking about what could be a 50 bagger, it's not going to be Walmart. I'm sorry. Like, you're not getting a 50 bagger on
Hey,
Walmart here.
hey.
Sorry,
Well,
sorry,
like,
Jeff. Sorry.
one thing I'm not selling, I'll tell you one thing I'm not selling, which has been just volatile as all hell, is, I'm not selling Petco, which, it's probably around my basis now. I watched this go from like whatever 250 to 7 and now it's back to 250. I'm not going to sell that because I think they can make it in a recession, and the rates coming down will be good for them. Like they need to refi in a couple of years. And one of the reasons that it didn't sort of propel higher all this time as they started to stabilize the business and because it got to a dollar, at one point, and, bankruptcy was on the table. And once bankruptcy sort of came off the table and they got a new CEO, they got the CEO of Five Below. So once it looked like they were going to live, it never really got that major boost because people have been worried about the refi. So like there are names like that out there. I think it's usually in levered equities. This could be an interesting time for levered equities with a decent underlying business because you're going to get the rate relief, but you just have to make sure that they can withstand a comp that's down 5 or something, in retail land, or, the similar analogy in a different sector.
Yeah.
Yeah, I think that's right. All right, let's call it. I think that's enough. That was really fun. Great session, guys. Covered a lot of stuff, and go
Kohl's
enjoy
is
this.
down 22%. I'm now fascinated. We should just keep talking until we can make it to the zero. And then we'll
Close to
just buy
zero.
it.
We're on till
We'll
close
buy it
to
at 50
zero.
cents. Let's put in a bid right now and shit talk it all day and get it to 50 cents, and then we'll buy it. It'll be a nice little
I
flip.
mean, go have fun with this market. It's a super fun time out there. Uh, it's just like, it's like going to Dave and Buster's, it's like playing air hockey.
Who doesn't love air
Tariff on,
hockey?
tariff off. Stocks up, stocks down. Anyway, all right. I'm Benjamin Bry, Bernard Barchet, Jeff Mackey. We're the consumer team of Wall Street Beats, and we hope you enjoy your day and come join us again.
Go to the mall, for God's